Today, we're going to be talking about a concept where we leverage an IRA, an annuity, and life insurance to create a bigger after-tax legacy than maybe what we could if we were to leave the monies invested. So first off, my name is M Stackhouse. I am a certified financial planner and an investment advisor that has my own practice along with insurance agency helping my clients with these types of topics and conversations. So before we begin, please contact your financial services advisor, CPA, accountant, whomever it is that is helping you with these topics. This is just an idea to express to see if it is something that it may be of interest to you or your family or friends or anybody else that may benefit from knowing this conversation. So let's begin with a scenario. First off, art is not my subject or my passion per se, but I do enjoy making some drawings from time to time. So I will be flipping back and forward between this page and my spreadsheet, if you will. So this is going to be prospective client Jane Smith. So Jane is 65 years old. She has a traditional IRA worth about $1 million that she has no use for, meaning her financial goals are leaving as big of a legacy behind as she can, and she does not need that money to spend on her day-to-day living expenses per se. Rainy day comes up, different story. She's got other assets that she's going to fall back onto in this scenario. So for income brackets, we are going to assume Jane is currently in the 22% tax bracket based on her retirement income, along with the future generations. For simulation's sake, we're going to use a 40% tax bracket, and I'll explain why in a moment. So first things first, Jane, she has, again, that $1 million IRA. What we are considering doing is we are considering buying an annuity. So an annuity, if you're not familiar with them, it's kind of like yin and yang with life insurance. So most people know life insurance tends to pay out when you die, whereas annuities pay out for as long as you are alive if you are participating in some of their income riders and guarantees that the insurance companies offer. So I just pulled these numbers based off of what I'm seeing inside of my quoting system. So these are not applicable to you. These could be outdated depending on when you're watching this video. Again, this is just for idea's sake to talk with an advisor on. So we'd be happy to help, and I'll leave my information at the end on this. But in short, let's say you put $1 million into annuity and it's going to pay you a 7.5% guaranteed lifetime income, meaning $75,000 gross, because that is inside of an annuity. So the annuity, the insurance company is going to pay that $75,000 back into the IRA for hypothetical sake. And then we are going to take the money out and pay taxes on it at 22%, or $58,000 after taxes is how much we would have left. So what would we do with that money? We would then go buy a life insurance policy. Now there are some complex or more unique opportunities where you can go put this life insurance policy inside of a trust to keep it outside of your estate if you have to worry about estate taxes. I think in the year of 2023, estate taxes for a married joint filing couple is like 25 million or something, almost $26 million. So this is a concept that can be used in order to avoid future estate taxes, and that number adjusts up and down over time. So something to consider. But we would buy a life insurance policy. The premium of $58,000 would buy today, Jane, a 65-year-old semi-healthy female, $3.5 million death benefit guaranteed with some insurance carriers. So one thing I want to point out, that is tax-free. That is big when you're comparing it to the IRA here in just a moment. So let's compare the math. Let's assume she instead decided that she wanted to wait and just let this IRA grow and grow and grow. I'm not going to assume RMDs because that makes this simulation or calculation a little bit more difficult. But in short, invest $1 million. Let's assume a 7% average compound rate of return, because that's what approximately a 60-40 portfolio has done based off of my research findings at the time of making this video. If she did that and left it invested for 25 years, because I'm assuming that she is making it to age 90 in this scenario, I think that's a round average number. That would leave her with $5 million and some change. If we needed to take the money out of the account, the beneficiaries now, whenever Jane passes away at age 90, that would leave them with approximately $3 million after tax if they took it all out at once and paid all the taxes on it, or even if you wanted to spread that out over a 10-year period like what you can in today's world. So why that number is relevant is because if you compare this number to the life insurance death benefit that would get paid out, let's assume that Jane died at age 90 on the spot, then more or less, you are still going to be better off with the life insurance than you are with just leaving it in the investment account. Now, don't get me wrong. I have this other graph that I wanted to show you to kind of paint a picture as to why it's actually more advantageous to do it sooner versus later for an overall life value benefit calculation. But let's begin with the, well, let's go blue with your situation. So this is how the growth of the net worth would look per se in the individual. And I am going to use, in this sake, I'm going to start off at $1 million. That is day one. If you just left the money invested in an IRA, and by the time she turns 90, it's going to grow and grow and grow. 25 years from now, down at the bottom, it's going to grow into 5.4 million based on our math on the other pages there. And that is, again, by the age of 90. So let me change it up. Let's assume this individual bought a life insurance policy today with an annuity funding it inside the IRA. Well, day one, we've got a $3.5 million life benefit already. That's going to be tax-free as well, whereas the IRA is not in this scenario. But let's begin with that. Plus, day one, the annuity is still worth not quite $1 million because you took $75,000 out of it, but still another $920,000. That would mean that your legacy day one would be, I think it's 4.5, if my math is helping me, 4.425 mil day one if you pass away. And then slowly over time, after that annuity depletes down to zero, which is about 15 years from now, drops back down to 3.5 million. And then it's going to stay 3.5 million is what it's going to be worth until the end. So why I draw this graph on here is it's not quite perfect because this money up here is going to be tax, meaning that after tax, this 5.4 million actually drops down to right here of 3.25 million from our math that we did back in step 3 on this one. Yeah, 3.25 million. Whereas legacy benefit of the life insurance, again, is 3.5 million. So you can see there is a difference right here in this section, right here at 25 years where you're not going to have as much of a benefit. But why I like to draw this out is because this orange line should really be closer, should be 600,000. And why I drew that was like the taxes after the fact. So I hope that makes sense in my drawing here. Again, just thought this would be useful for a lot of individuals out there who have come across my office and wanted to have these types of conversations on how you can extend a legacy or try to eliminate some of the taxes and take that out of the equation. So hopefully this is useful. Again, my name is Corey Stackhouse. I am the owner and operator of Stack Enterprises, a full service financial advisory firm, but we also are a full service insurance agency as well. Not only helping out with financial planning, investment management, tax planning, and estate planning, we also do a lot of Medicare planning, homeowners and auto insurance. What else we got? Long-term care insurance, a bunch of other things. So just wanted to make sure I let you know that information. Please like and subscribe to this channel if you wouldn't mind doing so, and don't be scared to share this information with anybody who might benefit from a conversation, or at least having this conversation so they can know what may be better to do with their situation. So that was all. Hope you have a great day. Thanks.